Okay, let's see if we can connect with our next guest. Do we have Mr. Nikhil Ranka joining in? Nikhil, hi,
Good morning,
morning.
sir.
Can you hear me?
Yeah, I can hear you.
Hi, great to have you with us. And what a morning, right? I mean, it's been almost breathless. I've just been talking about gainers, and gainers across the board. This is looking good. It's a good Monday feeling to have, isn't it?
Yeah, so after a lot of to and fro, finally we have confirmation from both the sides, and even crude oil is actually supporting that. So my sense is, we've seen a lot of selling also. You see, CY24, CY25, we had close to 3 lakh crores of selling from FIs every year. And this year, in the first 6 months itself, they have sold close to 3 lakh crores. So seems like FI selling is also towards its fag end. And even before this settlement came, if you just see the FI numbers of the last 4 or 5 days, from 5-6 thousand crores, that number had dropped down closer to 2,000 crores. Friday was just 1,000 crores in that sense. So my sense is markets do have a decent legs now to continue with this rally, and we should have 5-6% more coming on the Nifty pretty fast.
Nikhil, now, if this war is indeed over, I mean, I think that's one of the questions that our viewers was just asking on our live stream on YouTube, that if the war is finally over, then can we expect that momentum-driven rally in the Indian equity market that has been missing for 2 years now? Non-stop FPI selling, stock prices not going anywhere, very short mid-cap rallies that end up being quite hard to, catch at the right time. So will the texture of the market finally change?
So, Survi, if you see two sectors which have taken major beating in this FI sell-off, one was clearly banking. So, if you see, in the case of banking, we have now a tailwind. So, the estimates for FCNR deposits is that we should raise close to $50 billion in the next 3-4 months with this. And if you look, the guys who will raise this will be the top tier banks, the likes of HDFC, Kotak, Axis, which will represent close to 150 lakh crores of deposit base. And if we do end up raising $50 billion, then that's almost a 3% kicker that you will have on the deposit base for these banks. So suddenly from a 11% deposit number, you will move to 14-15%. The loan growth can be actually closer to 17. And given the fact that these banks are now trading at 10-11 times 1 year forward earnings and 1.3 to 1.5 times FY28 price to book, my sense is there's a lot of upside that the markets will have to price in these names over the next 2-3 months. Because clearly that's one of the sectors where Q1 still will be good, and Q2 will have follow up on that. So banking will start to do well. Rest of the sectors also, if you look, OMCs, aviation, even in the case of aviation, a lot of cyclicality will now go away because you have a 10,000 crores ATF stabilization fund, which, when the markets are crude markets are down, will actually build some buffer. And when the markets are good, it will actually subsidize that ATF prices. So to that extent, the extreme volatility that you used to see in the numbers of aviation companies, that to some extent will go off. And the way crude has corrected, everybody knows Q1 will be very bad for OMC companies. But as we move into Q2, Q3, they will recover a substantial part of their losses in that sense. So for the broader market, and obviously infra, the likes of L&T and all those things, we will expect that there will be a lot of rebuilding activities that will happen in the Middle East. A lot of order inflows will start coming through. So my sense is IT and pharma, which were defensives in this fall, probably may not perform that well. But rest of the sectors should have a lot of momentum going on for them over the next 3-4 months.
Nikhil, what are your top market bets now? For the next few months, like you described, how would you change the portfolio?
Yeah. So, Survi, without naming individual stock names, on a sectoral basis, I would say, NBFCs and banks is top of the pecking order, because even yields, if you look at it, have cooled off from 7.15 to 6.85 today. We started the rally itself when the war broke out from 6.7%. So there should be some benefit of cost of funds for both of these plays. Second in the pecking order will be aviation, third will be OMCs. And historically, if you look at it, real estate in terms of an anti-consensus play, once markets stabilize, the wealth effect starts to come back. That's one sector that also starts to do very well in the late stage. So, given that the fact that stocks have corrected 20-25% from their peak, this could be a good entry point for some of the large cap real estate names with a 9 to 12 month horizon. And if over 9 to 12 months markets do go to make new highs, that's one of the sectors where you will see pre-sales activity starting to go up substantially in that sense.
In the lenders, Nikhil, and that point on yields is very well taken, because I think across the world, inflation expectations themselves will be reset if this war is indeed done and if oil stabilizes around 80. So on lenders, what's a better deal now? Should one be investing in banks or in NBFCs?
So you will have to be very, very stock specific. So plays where you will still see close to 18 to 20% growth. Some of the gold financiers, for example, where there were concerns of gold prices having corrected 20%, which would have affected AUM growth, loan to value ratio. They could definitely come back in favor, because we've seen gold prices go up 7-8% from the lows. So that's one part of the lending space which will clearly see some action coming back. And rest of the lending names also on the CV side where valuations had corrected should come back. So my sense is, probably the upside there could be 15 to 20%. Even for the large cap banks, I think 10 to 15% upside over the next 6 months is something that we will clearly see in that sense. And the point is, Surdeep, we are not expecting any more cuts now. So the NIM pressure is not going to be there for the banks anymore. The next action by the RBI with all these should be on the way up. And the fact that 60-70% of the book is either linked to repo or MCLR would mean that loans will reprice first, and then you will have repricing on the deposit, which should be incremental benefit for NIMs in that sense. So therefore, if you have a loan growth itself of 15-16% and tailwinds of NIM, then you are in all probabilities looking at a pre-provisioning profit of almost 17 to 20% for most of the banks.
Okay, got it. So banks are looking good. What else? Definitely, you're very convinced about the financial space, Nikhil. What else? And now I'm talking about a durable portfolio, right? I mean, we're talking about investments for at least 1 year. So financials, correct, definitely like you described. What else will you keep in that portfolio?
Financial, I would say even the top names on the aviation is something where, given that they have only increased market share, because the top name is the one which is still cash rich on the balance sheet in terms of net cash, is still sitting with close to 32,000 crores of cash. And this turmoil will actually accentuate market share gains. So in that sense, that's one of the sector that will do well. Even gold jewelry stocks, I would say, gold almost has given up 25% of the gains from the peak. So you will have some demand momentum coming back into jewelry buying, because at 2 lakh crores, obviously demand would have taken a lot of it. But now that prices are back to 1,50,000 for gold, I think there will be some demand momentum that you will see over there, and obviously that should translate into volume gains. So these are the 2-3 sectors clearly where I think one could look at portfolio rebuilding over the next 9 to 12 months.
Okay. Nikhil, somewhere in the conversation you also mentioned the market revisiting the all-time highs. And I think that's what people are really waiting for, right? They're waiting for India to start feeling the love again. We've been unloved for almost 2 years. So what's the chatter around? I mean, when you talk to some of your, H&I investors, the so-called smart money, when do we go back to all-time highs?
So Surbi, one of the clear reason was that, AI was the flavor of the markets in the last 3 months, and it clearly did not have an AI play in that sense. If you say some of the optic fiber names that did have a massive rally even when markets were falling. But now, if you just look at the FI positioning on the index derivatives, we are seeing close to $4.2 billion of shorts that they are running. There will be clearly covering on the index names because of that. And our weight in MSCI EM has fallen from almost 17.5, 18% to 11.8% now. So my sense is as the AI rally cools down a bit and our weight starts to go up, you will have this factor where domestic retail flows are still strong. We are still seeing close to 25, 30,000 crores of inflows on a monthly basis. And if this FIF selling ebbs, then you will have a very high impact cost when markets foreigners have to come back and buy these names. And we have now almost corrected for 18-20 months. We hit 26,200 in September. Earnings have grown by 7-8% for the next 2 years. So on a valuation basis, clearly India has become cheaper by 17 to 18% as compared to September 2024 levels. And if you see the earnings estimate for 27 and 28, in both of these years, consensus is building close to 15% earnings growth. So once you have that double-digit earnings growth coming back, and the fact that we are now close to 17 and a half times in terms of valuations, my sense is over the next 9-12 months, we should definitely see new highs on the indexes.
For the next 9 to 12 months. But Nikhil, in this whole conversation, we haven't discussed what has been the sore spot for India, right? And that's earnings. So while sure, I mean, momentum can come back, sentiment can come back, and maybe the FPI selling reduces, which will all help. But the problem is, and that problem hit us even before the war. I mean, that was a problem of 2025 when we didn't have a raging geopolitical conflict. But the single-digit earnings growth. Now, how do you expect that to change this year?
So the key reason, Surbi, we had that single-digit earnings growth was, if you see financials, which is the largest sector, we were in a rate cut cycle for the last 12-15 months. And what had happened because of that was most of the financial names, large cap banks were seeing pressure because of which if the loan growth was close to 12-13%, your pre-provisioning growth was just 7-8%. So that was one of the sore points. The second point was in the case of IT names also, you were at single-digit earnings growth. And also given that, infrastructure names, there was some pressure on government finances, you saw a slowdown over there. So a combination of these factors actually pulled down our earnings growth to single digit for the last 2 years. So if you see both FY25 and FY26, we have grown in single digit earnings. And then obviously the implied risk premium for FIs doesn't make sense because, if your markets are going to go up by 9%, your US risk-free is close to 4.5%, and, currency depreciates by close to 3-4%. Then for that incremental 1% doesn't make to bring a lot of flows to India. Now, with this FCNR deposits of $50 billion, there should be some support for the currency. Second, if you look at it, India imports close to 4.5 million barrels of oil every day. So if you just take a $20 lower crude oil prices, you save $100 million on a daily basis. On a sort of yearly basis, that will translate close to $35 billion of reduction on the current account deficit side. So all of these factors and the fact that because of a favorable base, your earnings could come back to 13-14% should mean that we should have some revival in FI flows going forward. So, my point is even if this FI selling, which is close to 5,000, 6,000 crores starts to ebb and, we see numbers of close to 1,000 crores, we will see the market starting to move up. And, once the market goes up, people who are sitting underweight India will have to increase their weight. And that should mean that the momentum will definitely come back to Indian markets.
Okay. All right. On that optimistic note, Nikhil, we will wrap up this conversation. It's been a good Monday. And like you're saying, that maybe another 9-10 months, we finally get an all-time high on the Indian market, something that investors have really been waiting for very patiently for almost 2 years. You have a good one. Have a great week, and thank you for joining us today.
Thanks, sir.
Thank you very much. Well,